All right, good afternoon. Today is Tuesday, June 7th, 2022. Glad you guys are here with us still. Um, if you can, during the recording, please put yourselves on mute. At the very end, I will open it up to questions. So for now, just put yourselves on mute. I think over the weekend, we had some new members come in. Welcome. All right, welcome to Checkmate Trading. We're a very focused trading group and we focus mostly on risk management as well as strategic positioning. Okay, let's start with the news of the day. This morning, before the markets opened, Target came out with a report, and it looks like they have some excess inventory. It looks like they need to make some space for incoming inventory. This is a deflationary force, of course. When we see inventories going up, and if you look at some of the inventory numbers for winter inventory, it looks like we're at a high for many retailers. So it's not just Target, but if you look at all these brick and mortar retailers, they're all probably experiencing the same thing as far as inventory buildup is concerned. So it'll be interesting to see if this causes some deflationary pressures going forward, and then how will the Fed react to that? Okay, so we'll see. Time will tell. But a lot of people are saying, well, this is huge. This is huge news. This changes everything. Well, really, does it? Does it really change anything? I think this is just confirmation of what we already kind of knew. I think a lot of people already knew that this was going to happen, that we're going to see inventory build up in certain inventories, because we had that supply chain backup because of China and Shanghai, closing. So I think this is something that already a lot of people knew and already were flat for the day in the markets. And it has recovered most of its losses so far. I mean, we'll see at the end of the day if it makes any difference. But it looks like we're seeing, the markets just shrug that news off. Again, this is just it appears as if this is just confirmation of what we already know. One of the things that actually may change things going forward, especially with our supply chain backup, is China is actually reopening. It's not just talk anymore. They're actually making some steps. And actually, you know what? I just realized I haven't even shared my screen yet. So let me go ahead and do that. Let me share my screen. There you go. All right, so let's take a look at what's going on in the markets. As I said, China right now is actually making steps to reopen, and it's not all just talk. As we can see in the Aussie dollar, we have seen the Aussie dollar really rally because as China reopens, they're going to be buying a lot more metals, and they usually buy a lot of their minerals from Australia. And as we noticed from last week as well too, we saw copper prices go up, right? They're starting to fall a little bit, but still, they're still above their breakout levels. Actually, it touched a little bit of a low, and it's already recovering some of its losses for the day. So these are all things that tell me that maybe this reopening from China, all this rhetoric coming from there, maybe this time it's real. Maybe they really are taking real concrete steps in reopening. Let's see how metals are doing. Metal miners are doing very well today. Look at that. 1.43% up today. So it looks like there's some demand for metals. Let's see here. What else? Let's take a look at some of the other metals. Gold. Gold is also about 0.5% up today in trade. But really, what's really telling about this whole China story, it really is the Aussie dollar. Um, I think if China really fully reopens, I mean, we could see the Aussie dollar go up, break out into this zone right here. Is it something tradable? Is it something that I'm willing to go long on? Absolutely not. Absolutely not. I will, even if the Aussie dollar goes up to here, I will just be a viewer and not participate in that. Because if it falls apart, I mean, Aussie dollar could go right back down, and we could see copper going back down as well too. Um, so we'll see. We'll see what happens with that. All right. Today, as far as markets are concerned, you know, um, we recovered some of our losses. In the Discord today, I said that if it can't hold that 4080 level, it's safe to say that the bear market rally is over. I still believe that. If we lose that 4080, I think there's going to be a lot more institutional demand. That's where the options positioning, I think, you'll see a lot of people end up, selling calls and buying more puts right at 4080 if we lose that. I think a lot of people went long. If you look at institutional orders and some of the large block orders on some of the big ETFs, you can see that in a lot of these, also tech stocks and small cap stocks got a huge bid in the last 2 or 3 weeks. There was a huge amount of block orders that came in around this zone right here. All right. And so all those shares will need to get hedged if it breaks that level, right? Or it might get sold, but usually institutions don't sell, they'll just hedge. So I can see hedging demand increasing if we go below those buy levels from all those block trades that happened right here. Again, IWM, SPY, QQQ, Apple, Microsoft, Amazon, all these stocks had huge block orders right here. So if we lose that level, I think the demand for hedging will increase. So we'll see. We'll see what happens. Earlier today, if you look at the casino, I made a bet for, what was it? Let's go to the casino real quick. I'll put the casino up on the screen right here. So as you can see, at 10:26 a.m. Eastern time, I made a bet for 411.57. And there's actually a reason I have it at that time and at that number. It wasn't just some random bet. But if you actually look at what happened at that time, at 10:26, we were right here. We were right here, and I was saying, hey, we have a very good chance of breaking this zone. The reason why is right here, I saw a lot of put sells coming through on the options exchange. SPY, SPX, huge put orders coming through. Shorting puts, probably short puts that are in inventory, probably getting sold off. Institutions cashing their hedges. And remember from last week what I said, for market maker delta hedging, as puts get sold, the market maker has to buy those puts. Buying puts as a short position. So to offset that delta, they have to buy some shares because they have a short position. They need to get into a long position to offset that. Okay. Not only that, as the VIX falls as well, and as implied volatility falls on these options, you start seeing some delta decay. All right. So already, with delta decay, the market maker has to even its books. So there's already a little bit of buying pressure. And at the same time, if institutions start selling off their puts, well, then you could see there is kind of a race to buy more shares. And this is what this is. This is a race to buy more shares, a race to even out your deltas in delta positioning. So that's what we kind of saw today. All right. And right as I saw that, I made that bet right around here, I saw those puts getting sold off. So, if you've got Thinkorswim, it's not a bad idea to have, that the trade tab open and looking at those options trades come through. Once you do, you know that, hey, there's a very good chance that we get a little continuation. So if you're a day trader, that actually is a great signal for you to use to get long or short. If you start seeing a lot of put buying happening and the VIX spiking, then that is that's a very good signal that maybe you should buy some short dated puts for a temporary day trade down. So it works both ways. So, that's something that you could use for day trading. I don't do a lot of day trading, that's just me. I just tend not to do that. But if that's your thing, that's one of the signals. Now, I like to use the VIX and the options flow for a little bit more longer signals. I try to look at more monthly options expiration plays, but it's up to you how you want to use it. There's a lot of people out there that do very well day trading, but it's just not for me. We did take a UVXY short, a UVXY put, 12 puts for June OpX. And that's really because if you take a look here, VVIX is the VIX of the VIX. It tells us the premiums, how expensive premiums are on VIX and, on VIX products as well too. So as you can see here, we're at pre-pandemic levels. We're at pre-pandemic levels right here. So it's cheap. UVXY, VIX, those kind of options are really cheap right now. It may not even be a bad idea. We have a belief here. The thesis here is that right now we're just in the middle of a bull market rally, but the overall trend is down for this year. We're in a downtrend, but we're just in a very temporary bull market rally, which is a correction in a bear market. All right. So I do believe that this will continue and we will see lower lows. That's just my opinion so far. And we've been talking about building hedges for this. With the VVIX being this low, all right, call spreads, 6-month call spreads on UVXY don't seem like a bad idea. If you look at the December expiration for UVXY, this is just an example. I'm not taking this yet. All right. I still think that we've got a little bit more higher to go. And that's when I'll start hedging. But if one were inclined to start hedging now, and of course, these hedges are something you want to build over time, because as markets drift higher, you get better pricing on hedges. So, I don't recommend hedging all at once, but if one were inclined to start, those 16.21 vertical call spreads are under $1. Now there's a huge spread on them and volumes are very low. So it may be very difficult for you to get a fill, but if one were patient, you could put an order in for that. It gives you 6 months for UVXY to get into the 20s, and I think if we have a big sell-off, it's very possible that UVXY can get into the 20s, possibly even the 30s. So for $1, you'd be able to get close to $5, and of course there's going to be spread, so you may not be able to get the full profit. And also, if it happens sooner than later, the gamma is not going to work towards your favor. Gamma works more towards your favor closer you get to expiration. But then there's also the matter of fill. I mean, look at the volumes. The volumes are very low, so that's why I'm not even going to attempt to try and do this. I probably wouldn't be able to get a position that's good enough to hedge my portfolio with this, but. For some of you out there, maybe you want to try for that. We'll see. And right as I said, I expect the markets to go a little bit higher. Look at that. The market just drops. Look at the timing on that. So who knows, right? There's no crystal ball to this. So maybe it is wise to start hedging now. I'll still wait and take a look and see if we break that 4080 by end of day. I may go for maybe even shorter dated puts or shorter dated put spreads on the indexes like SPY or IWM or QQQ. I may do like maybe a 3-month one if we close under that 4080 area, because I think there's a very good chance, and the demand for hedging is going to increase significantly if we close below that level, just because that's where a lot of institutional block orders came in. I know I'm repeating myself a lot right now, but there's a reason for that, because I think it's important. That level is very, very important. So just keep that in mind. So that's what I see in the indexes so far. Speaking of delta hedging, let me go to, let me go to this here. We'll come back to UVXY in a second and discuss Contango. But since we're on this topic of delta hedging, I wanted to go to Deribit. Remember last week we said that we were looking at not this week's but last week's weekly expiration. And remember how we said that? I don't need positions. Yes. Remember how at the time, I don't know if I have the chart up. Yes, I do. Okay. So at the time, last week, which is today's the 7th, 6th. So yeah, at the end of last week, I said that there was a lot of puts at 3,000 and calls at 32, and that would be the likely range. And it looks like it played out. It looks like it exactly played out like that. And then on Thursday at the end of the week, I said, hey, next week's it looks like it's more 2,800 to 3,200. So that 3,200 level is still where we see significant call wall, even for this week. That's the daily. Most of the volumes are in the weeklies and quarterlies, at least on Deribit. I don't know on other exchanges, but Deribit has most of the open interest for Bitcoin and Ethereum options. So, right now on calls, yeah, it still looks like 3,200 is the call wall for this week. And for this week, it still appears as if, we've got significant open interest and volume on 3,000, but we also have that for 2,800, just like the same from last week when we looked at this week's expiration. So there's still some demand for 2,800 hedging and 30,000 hedging as well too. So we'll see. Again, it's just an observation. I'm not taking any trades because of this. This is just an observation. The observation was that Bitcoin is getting a lot more institutional participation, especially when it comes to dynamic options hedging. So, this means, as time goes on, and if this is proven correct, it means that institutions are accumulating Bitcoin positions, and they need to hedge. They need to remain delta neutral. So if that's the case, hey, that would make it more interesting as a trading vehicle. I'm staying out for now. I'm staying out of this for now, but we'll see. As time goes on, if we get proven right, then we'll use that as one of our weapons. But for now, we just sit tight and watch. Okay. But so far, it's playing out as we towards our thesis. So that's kind of interesting. All right. Now let's look at some of our current positions. Today, again, we opened up that UVXY puts. Are we doing well on those? Well, we're at around break even. I bought it at 23. We'll see. Look at that. See? You tell me, is UVXY long a good hedge? Is actually buying shares on this a good hedge? No, it's not. But right now, again, the reason why I'm considering, I haven't done it yet, I'm considering UVXY call spreads is because the VVIX is so low. The implied volatility on those options are just so low. All right. That's why I'm even considering it. But again, long term, I mean, this thing is meant to just decay. If you want to take even a longer approach, look at that. I mean, this thing just decays. And the reason why it decays, all right, the reason for that is because of Contango. And I know a lot of people have been asking me, well, what's Contango? So basically, let's go to one of my favorite resources is VIX Central. It shows you the term structure of VIX futures. So futures contracts, just let me just go briefly into futures contracts. So futures contracts are mostly in commodities. They promise a future delivery of a certain good at a certain price. And so, for example, if you buy the July futures contract for crude oil at $115, basically, then which you're buying for that delivery, for July delivery, 1,000 barrels of oil for 115. Okay, and the same thing if you're a oil producer, you can sell these futures contracts, basically locking in your sales price for oil. So if there was a lot of volatility and oil was trading between 110 and 120, and one day it goes to 118, and you're a producer and you say, you know what, I want to lock in these prices just in case if it goes down to 110, you can sell a futures contract, and you're on the hook to deliver 1,000 barrels per contract at $118. All right, and the same thing if you're like an oil refinery and you want to lock in lower prices. Let's say again trading range 110 to 120, and oil is at 112, and you say, you know what, I don't want to risk it. If oil goes back to 120, let me lock in this 112 right now, and I'll just take physical delivery. And so that is how futures contracts are used by commercial entities. All right. Now, obviously, there's a lot of speculation in futures as well. And then there's also futures contracts on things that are not deliverable. For example, indexes, VIX futures, whatnot. And so UVXY is an ETF that uses the VIX futures contract to replicate movements within the VIX futures. All right. So Contango means that the front month, the closest expiration, is lower than the months coming after that. Okay, so again, Contango means your front month is lower than your months after. Backwardization is the opposite. That is when your front month is higher than your month in the future. Okay, so let's just look at Contango for a second here. Okay, this is Contango. All right, front month is lower than back month, and the reason why UVXY or any ETF that uses a VIX or any type of futures rolling strategy decays during Contango is because they have to. They usually often employ a rolling strategy where a portion of their front month holdings they sell on a daily basis and they buy the next month. Well, if your front month is cheaper than your next month, there's going to be a little bit of a decay. Let's say you have 1,000 contracts at 25.62, and all of a sudden now you have to buy contracts at 26.970. There's going to be, you're paying a little bit more per contract. So there's going to be a little bit of a decay on that. So if you look at UVXY, if you look at their website, this is their daily holdings, and this gets updated on a daily basis at close. So as of yesterday's close, this was what was inside the ETF. All right. And every day, this number will go down and this number will go up. and it's leveraged. They actually employ they actually borrow money, use leverage, and that's why UVXY does. It on their prospectus it says that they do 1.5 times, or at least that's the goal, is to replicate the VIX futures movement times 1.5. So this is how they get that ratio. But every day they sell a little bit of this to buy a little bit of this. A little bit of the front month to buy a little bit of the back month. And again, if it's in Contango, if this is more expensive and they're buying into this and selling the cheaper one, well, what do you think happens? Of course, it decays, all right? And when this Contango percentage and amount increases, that decay is even faster. There's more decay per day. Now, of course, if VIX futures go up, UVXY also goes up too. But still within there is a decay that is built into it during moments of Contango. Now, in moments of backwardization, when your front month is more expensive than the back month, you're actually seeing the reverse of decay. Actually, then if VIX during moments of backwardization, if the VIX futures doesn't move and if all variables are stay the same, UVXY will actually appreciate in value during times of backwardization. But usually times of backwardization are during VIX spikes and risk events. Those are not as common as Contango in the VIX futures market. Let me tell you what market is in backwardization. Most likely, I think right now, yeah, look at that. So if you look at oil is in backwardization. Front month is higher than back month. So right now, ETFs that use rolling strategies on oil are appreciating in value with everything being held constant. What is USO doing? USO uses that strategy as well. I think they changed the methodology though. I don't think they used the direct front month. I think they used not the front month, but these 2 months. I could be wrong, but there's still backwardization in that. So oil is up on that one, 94. So what, around 0.7, 0.8%. And see, this one's up 1.2 because there's a little bit of added. There's a little bit of an increase because of the roll, because you're rolling into a cheaper contract. So you see it's a little bit, it's supposed to do what the oil futures is doing, but it's done a little bit more. And again, it's because of that roll. That's the effects of that futures rolling strategy. It's in backwardization. Okay, hopefully that was helpful. During this whole time, I didn't even check our chat. Let me go into the pit chat. Do you guys have any questions? Anything you guys want to look at? Oh, where do you see the put buying, as in where should we look? Oh, so if you look at the trade tab, and this is just for CL, on Thinkorswim, you can actually do options, time, and sales, and take a look at all the options trades right here. I just set it for the time. Right now, it's set to the quantity. But I take a look at this on a regular basis. This is what I'm looking at. I'm not really looking at charts. This is the screen that I'm mostly on when I trade. But that's just me, I like to look at this kind of data. I think this is more telling than anything else on a chart. Any other questions? Okay, I'm gonna keep the recording going. If you guys want me to, I can include the questions like last time in the recordings, or I can take them off. So what's the vote? Do you want me to stop the recording here, or Should I keep it going for the questions? Keep it going? Okay, I'll keep the recordings going. Let's open it up for questions. Unmute yourselves. Talk one at a time. Be respectful, okay? So y'all can get off mute. No questions?
Do you quickly just show, so with backwardization, it's basically the opposite of appreciation sense, or?
Backwardization just means the front month contract is higher priced than a later dated contract. That's all backwardization means. Generally in commodities, you see backwardization when there is a rush demand for commodities. Usually, when we think about a crisis here with equity, as equity traders, we think of crisis as prices coming down, right? With commodities, it's actually different. In commodities, you have a crisis when there's a huge shortage, all right? And so when there's a huge shortage, prices will crash upwards, all right? And so generally in commodities, when you see that excess demand, short-term demand, let's say, I don't know, the Saudis stop pumping oil or there's a war going on, you will see oil and commodities go into backwardization because getting that delivery now has to be secured. So that demand for that front month goes way up. So that's why you see backwardization in commodities when there's a crisis, quote unquote, crisis situation. I hope that answers your question.
Yeah, thank you.
Okay, very good. Any other questions? Let's take a look at the markets real quick. VIX is going down. SPY's coming back up. It looks like we're going to be chopping around here for a bit. I think it's going to be choppy. I think the markets are going to be really choppy, at least for the next couple of weeks. I think that we're going to see a yield spike soon. I'm revising the timing of that. I said in about 2 to 4 weeks. I think it could be anywhere from 2 to 8 weeks, actually, depending on what happens with rate markets in Europe as well. So we'll see. As we get closer and closer to June OpX, I will be sharing more data about that. But I do think that a yield spike is in our near-term future soon. I think 2 to 8 weeks. I think we're going to see that. And hopefully we'll have an opportunity to hedge that because if the yield spike, I do think that we're going to see some downward pressure on a lot of stocks, especially credit-sensitive parts of the market, which is QQQ and IWM. So I'm really looking at building some put hedges on IWM and QQQ. And if the VVIX stays low, I may even venture into some call spreads on UVXY. We'll see. We'll see how that goes. Somebody was about to ask a question before I started going on that last tangent there. You can unmute yourself and ask.
How would this Contango decay impact options trading on those ETFs?
On UVXY, well, on UVXY, if Contango widens, the decay is faster. So that's why I've been so confident in my lottos with UVXY. It's because that Contango is widening. Actually, let me see if I have that chart. I think I still do. Ah, yes, this is the front month minus the back minus the second month in UVXY. And as you can see, every time it breaks that 2 level, we've seen a rally into OpX. So will we see that break here? I have a small lotto just in case if it does. If it doesn't, oh well. It is what it is. But I do see that dropping. But who knows? I may be wrong. But right now, if I look at UVXY. I mean, you can see it yourselves. I have a position. Oh, we're up. I bought it at 23. It's at 25, 26 now. I'm going to hold it. I think, Wednesday, Thursday, I'm not going to hold it for Friday. No matter what, I'm going to get rid of this on Thursday. That CPI report that comes out, I believe it's Friday. I'm not holding onto this just in case. I'm not going to predict where CPI is. That's a fool's game. Not going to do that. So I'll be out by Thursday, end of day. I think this has a potential. I think UVXY, if Contango increases, we're going to be in the 1220s, maybe even like right at 12 or even under by Thursday. And if that happens, I mean, these could be like 50, 60 cents a piece, which would be nice. Small lotto, small gains, just a little extra to pad my my hedges that I built, my put walls on IWM and QQQ, as well as potential call walls on UVXY. So that's going to be my main portfolio hedge that I start building hopefully this week or next week. We'll see. We'll take it one day at a time. Any other questions? Going once. Going twice. Hold up. Toasty's typing. Let's see what Toasty says. Okay, that's not related. Okay. All right, so I'll stop the recording right here. I will stick around in the pit for any stragglers or any other questions or any other topics you want to discuss. I see Ari typing. You got a question, Ari? There's no is and backward. Is it backwardation? Am I saying the word wrong? Oh, it is. It's backwardation, not backwardization. Okay, whatever. You know what I meant. Okay, backwardation. When VX1 is higher than VX2. Okay. That's what mathematically, I know what I'm talking about. Okay. So yeah, maybe, English is a second language for me, guys. So stop picking on me. Okay. Okay, guys. All right. Very good. So, that is for today. I'll put this on YouTube and hopefully it'll be available by end of day today for those of you who want to review. Again, let's look at the big picture here. The main trend is down. This is just a correction of a bear market. This is a bear market rally. Always remember that. Do not take too big of long positions. Even though I'm going long on equities, like, short term, don't put too much weight onto those trades. The main trend is down. The easy trade right now is to build put hedges on indexes at higher levels. Okay, that's the easy trade. Trying to go counter trend is very difficult. All right, it's not an easy trade to do. So if you want to keep it easy, wait for higher levels, build your put walls then. Okay, so keep that in mind. That's the big picture. All right, guys, stay safe, and we will talk soon. Have a great day, guys.
Thanks, Mick.